The exact second your truck is loaded with goods and you hit the open road, your risks immediately multiply. Just think about it for a second. You are hauling thousands, sometimes hundreds of thousands of dollars worth of product right behind you. Welcome to This Explainer, where we're going to break down absolutely one of the most crucial types of coverage for anyone in the trucking industry. Whether you're an independent owner-operator, part of a small fleet, or managing a massive logistics company, truly understanding your insurance is literally the difference between a minor headache and a total overnight business collapse. Let's dive in.
So it's a question every single trucker has to ask themselves at some point. What actually happens when your cargo is damaged, lost, or stolen during transit? Because without the right insurance in place, the answer is, well, it's pretty grim. A single incident, just one bad storm, one accident, or one break-in can deliver a massive business-ending financial blow. It means the cost of those goods comes directly out of your own pocket. And we are here today to make absolutely sure that doesn't happen to you.
All right, here is our roadmap for today's explainer. 1. The cargo insurance safety net. 2. What is actually covered. 3. Key exclusions to watch for. 4. Matching freight to coverage. And finally, number 5, costs and smart buying choices. Section 1. The cargo insurance safety net. Protecting your livelihood on the road. Okay, let's start by looking at a very specific legal concept. It's called care, custody, and control. Motor truck cargo insurance protects the cargo you're hauling specifically while it is in your care, custody, and control. Basically, this means the coverage applies during transit. The minute you sign for that load, whether it's electronics, food, furniture, or hazardous materials, you are legally responsible for it. The buck stops with you. So if something happens while it's in your possession, this insurance protects you from having to shell out for the damage out of pocket. It ensures your business stays financially secure, even when the totally unpredictable happens. Section 2. What is actually covered? The major protections against physical damage. So, generally speaking, motor truck cargo insurance covers physical damage to the goods you're transporting. And this really breaks down into 3 main pillars. First up, damage to cargo in transit. This is stuff like if you're involved in a collision and the goods are destroyed. Second is theft of cargo, which is a massive, massive concern, especially in high-risk areas. And third, weather-related damage. We're talking things like hail, sudden floods, or extreme temperature fluctuations that completely ruin a load. Let's look a little closer at how these scenarios actually play out. Picture this real-world scenario. You're hauling a highly valuable load of electronics. You've been driving for hours, you're exhausted, so you pull over at a rest stop to grab some sleep or a quick meal. But when you return to your rig, you find your truck has been broken into and the cargo is gone, stolen. Without cargo insurance, the financial burden of replacing all of those stolen electronics falls entirely on your shoulders. But with the right coverage, your policy actually steps in to cover the loss or the value of those stolen items. It is quite literally the difference between continuing to operate and going bankrupt overnight. Now let's compare collisions to weather events. On one hand, imagine you're hauling furniture for a client and unfortunately you get into a collision. The furniture is totally crushed in the crash. Cargo insurance covers the replacement or repair costs of that furniture. On the other hand, let's look at weather-related spoilage. Say you're hauling perishable food in a reefer truck. A sudden massive hailstorm hits, or maybe a flood damages the truck, or you even just have a mechanical breakdown, and all that temperature-sensitive food spoils. Comprehensive cargo insurance covers the cost of replacing those goods, which, again, saves you from a totally devastating out-of-pocket expense. Section 3. Key exclusions to watch for. The hidden potholes in your policy. All right, this next point is absolutely crucial. You have to understand the difference between the cargo and the truck itself. We need to debunk a very common industry myth right here, right now. Motor truck cargo insurance covers the physical goods being hauled. It does not cover the repairs to your actual truck. So if you're in an accident and your cab or your trailer is mangled, cargo insurance isn't going to fix it. For damage to your own vehicle, you need physical damage insurance, like collision or comprehensive coverage. Please do not confuse the two. There are a few other major exclusions you really need to be aware of. First off, damage that occurs before the cargo is even in your possession. So if a shipper accidentally drops and damages goods with a forklift at their warehouse before you even load them up, your cargo insurance won't cover that. That's squarely the shipper's responsibility. Second is general wear and tear. If you're hauling furniture and it gets a few minor superficial scratches during transit that don't really affect its overall value, yeah, that's generally not covered. The policy focuses on significant damage or loss. And third, And guys, this is a big one: improper loading or handling. If you fail to properly secure the cargo and it gets destroyed because it shifted during a sharp turn, your insurance company may flat out deny the claim. It is your responsibility as the trucker to ensure that load is secured. Moving on to Section 4, matching freight to coverage. Different loads require different protection. Your coverage needs instantly shift based on the specific cargo you're hauling. It's not one size fits all. If you're hauling general freight like dry goods or clothing, a standard cargo policy is usually enough to cover the basic risks of accidents and theft. But let's say you're a reefer hauler transporting perishable food. Now you face the very real risk of temperature fluctuations, so you must ensure your policy includes specialized spoilage coverage. What about hauling hazardous materials, or hazmat? Well, now you face the massive risks of chemical spills, leaks, and cleanups. You absolutely require a special hazardous materials endorsement for that. And finally, high-value goods, things like luxury products or art, face a huge risk of targeted theft, so you're going to need a policy with much higher payout limits. Bottom line, you have to match the policy to the load. Section 5, Costs and Smart Buying Choices, the financial realities of coverage. Let's talk numbers. When looking at average annual costs for small to medium operations, your premiums are calculated based on cargo value, mileage, and your deductibles. Keep in mind, higher deductibles can lower your premium up front, but it does mean you pay more out of pocket if you actually have to file a claim. Now, for general freight, you're typically looking at somewhere between $500 and $1,500 a year, averaging out around $1,000. But when you step up to refrigerated goods, that added risk of spoilage pushes that cost up. You're looking at between $1,000 and $3,000 annually, averaging around $2,000. So you can clearly see how hauling specialized freight directly increases your financial investment in insurance. But then we look at hazmat. Because of the incredible, almost unimaginable liability involved with hauling dangerous chemicals, just think about the staggering costs of a full environmental cleanup if there's a spill on the highway. Hazmat policies start at $3,000 and can easily cost well over that annually. It's simple math. The higher the risk, the higher the premium. So, how do you make absolutely sure you're making the right choice for your business? Well, here is a clear 3-step action plan you can use today. Step 1. Assess your freight type. Be completely honest with yourself about what you are actually hauling. If it's temperature sensitive, get the spoilage coverage. Step 2. Get multiple quotes. Seriously, don't just take the first offer that comes your way. Compare prices and coverage options from a few different companies. And Step 3. Ensure adequate coverage limits. A huge, incredibly common mistake truckers make is underinsuring their cargo just to save a few bucks on premiums. Think about it. If you're hauling $100,000 worth of goods, a $50,000 limit leaves you dangerously exposed. Don't do it. I want to leave you with this final thought to really chew on. Is your current policy truly protecting your livelihood? Or are you just one hailstorm, one break-in, or one simple mistake away from absolute financial disaster? Your trucking business is your livelihood. Please, don't let a forgotten exclusion or an underinsured load take the whole thing away from you. Make it a habit to regularly review your policy every single year. Update it whenever your freight types change, and ensure that your time on the open road remains genuinely secure. Thanks for joining me on this explainer, and hey, stay safe out there.